Well, hello, Canada, and hello, BNN viewers from coast to coast to coast. No, it's not a hockey game. Although I do have hockey on my mind this week with the incredible run the Toronto Maple Leafs are on. Good thing it's not the playoffs because we would be disappointed again. This week we have from our nation's capital joining us, Mr. Drew Burgess. Drew is a ETF specialist with BMO ETFs, and he's going to talk to us tonight about some of the new tools they have and some of the different ways that you can seek income by way of ETFs. So that should be very interesting. I've had a great, and terrible up and down week. And I knew I wouldn't have a lot of time this week to get overly prepared. So tonight, my focus is really going to be on open questions. So fire your questions into the chat, and we're going to look at charts. Ask me about ETFs, ask me about individual stocks. We'll show you some of our analysis techniques. We'll really try to take a deep dive on some of these names and look at analyst estimates and research, and ask me about what's going on in the world, and hopefully we'll have a lot of fun tonight. But just to let everybody know, I became a grandfather this week, which has been very, very exciting. That was the highlight of my week. We had our first partners conference live event in a couple years, so that was really great. And then on the way home from downtown, I got rear-ended in the car, but I stopped in to see my grandson for the first time. So it's been really a week of ups and downs. That really explains the market's reaction. I'll talk a little bit about the volatility that's come in here. Once again, thanks to our partners and all our sponsors for making these events possible, and to our great friends at BMO ETFs for their support and ongoing partnership. And of course, for those of you who really enjoy these events and have contributed to one of our charities of choice, thank you very, very much. Cancer research and leukemia in particular at the Sick Kids Hospital, and dementia and Alzheimer's research at the Baycrest Foundation, two charities that are near and dear to ETF Capital Management and all our partner firms. And for those of you who have sponsored, thank you. And those of you who are considering it, please do. And we'd be thrilled in this holiday season to match those donations from all our BNN viewers. So tonight's speaker, as I highlighted a few minutes ago, Drew Burgess, joins us from our nation's capital, and he's a director of ETF distribution for Eastern Ontario. And I will now go on silent mode, and I will be back in about 15 minutes. Drew, take it away.
Thanks so much, Larry, and really appreciate the warm introduction, and a big congratulations to you as well, becoming a new grandfather. Exciting times all around. And it's a pleasure to be here with all of the viewers at home as well. I'm going to jump right into the discussion tonight and spend about the next 15 minutes or so on the topic of growth and income for investor portfolios. As we know, all investors have their own individual, unique goals and objectives. And really my goal by the end of this next 15 minutes is to leave you with two key takeaways. The first, the reasons why an investor may prefer to have more growth, more income, or perhaps a mix of both in their portfolios. And the second takeaway, a couple of examples and illustrations I'll share on ways to include income or growth ETFs in a portfolio. Now, one of the key considerations today is inflation, and I wanted to add this slide in at the beginning here to really set the stage on inflation when we consider whether or not perhaps we need more income or growth in our portfolios. And a colleague of mine actually came across this personal inflation calculator tool from the StatCan website. And surprisingly, the Stat Canada website is actually really easy to navigate. There's a tremendous amount of information relating to past and current inflation. You can actually narrow down specifics of what is driving the CPI number. For example, if you're interested in specifics on food price inflation in the CPI number, you can look at specific foods that are seeing more or less inflation. And as we all don't have the same consumption habits and patterns, I found this tool again really interesting as it allows users to input monthly expenses depending on how we spend individually. So for example, you can see on the screen groceries, eating out, going down the list, gasoline, and inputting your monthly expenses. What will be provided to you is a breakdown of and a calculation on what inflation looks like on each of those expense lines based on how CPI in Canada looks today. So I thought this was helpful as it really brings the awareness of inflation into focus, as well as this personal inflation number. And it can actually help us to better assess more around what may be important to us as we look to our investment portfolios. So on the next slide, why does growth in a portfolio matter? Why do investors need growth? Well, there are a number of reasons. The first, investors have their own unique time horizons, different investment goals, different risk levels, or willingness to take on risk. And if you think about where inflation is headed, and on this slide, looking to the right-hand side, the markets are pricing in just over 3% inflation over the next 5 years. So what does this mean? If we're faced with inflation numbers like that, we may have a need to really look at maintaining our purchasing power of at least that 3% number. So another way to look at it is if inflation's running on average at 3%, we're really faced with concern perhaps that the after-tax real returns after inflation and after tax may not be sufficient enough to really offset these rising prices. So for some investors, they may make it a goal to perhaps target more growth in their portfolio to offset these inflationary pressures. Now, on the next slide, we can take a look at the portfolio from the income side of the equation. So income investors are also unique. Most income investors may be approaching retirement, in retirement, or simply just need income on a monthly basis to offset expenses. So again, it all depends on the unique individual goals of the investor. But again, we're facing some headwinds. As we can see on the right-hand side of this slide here, what we've charted out goes back to 2000, and we're looking at US Treasury yields and the Government of Canada 5-year bond. Two very low risk investments. And what we can see is that back in the year 2000, these low risk government bonds were generating just north of 5% yield. But the trend for the past 2 decades has been that these relatively risk-free or very low risk government bonds have been seeing plummeting yields. So today we can see that that same bond from the year 2000 is generating just over around 1.5% yield. So with this in mind, those income yield focused investors who need yield from or income from their investment portfolios are really forced to look outside of fixed income and more to the equity side or alternative income sources to fill this gap. This is a really good core illustration on the next slide, a core balance fund. And I'm going to use this for the illustrations on the following slides. A core balance fund is a 60% equity weight, 40% fixed income. Now, that asset allocation between fixed income and equities will change depending on the investor. So for those that may be more growth oriented, the equity component could be 80%, fixed income 20%. And for more conservative investors, we may see 60% fixed income, 40% equity. So I'm going to use this balanced example as a core for the following illustrations. But what we can see here is the fixed income side of the portfolio is really there for stability. As we saw in the previous slide, yields have consistently been moving lower. So the fixed income part of the portfolio is, in today's environment, no longer that strong source of income. So again, we're really looking to the equity side to do more for our portfolios, both on the growth and income side. And I will point out here, I've highlighted a couple of the more popular balanced ETF portfolios from BMO, ZBAL, Vanguard, VBAL, and iShares XBAL. You'll notice that a balanced portfolio on average generates about 2% yield And with these three portfolios, they pay a quarterly distribution. Now, the next few slides, I'm just going to dive into a few ways that we can start with that core balance portfolio and tilt the portfolio depending on, again, our own individual needs, goals, and risk levels. So I'm going to focus on the equity side of the portfolio to make these tilts, as we believe there are very attractive strategies that can help both on the income and growth side of the equation. Now, when we look at equities on the next slide to get the growth or income, it's important to keep in mind the increased volatility. And I always highlight this, that as you add more equities to a balanced portfolio or to a conservative portfolio, you may be adding more risk and increased volatility as well. So for income tilts, you may be giving up some growth potential to generate a higher level of income. But with income strategies, you'll likely have lower volatility and a lower standard deviation. So on the left-hand side of this equity spectrum here that you see, the premium yield ETFs are primarily focused on income and much less on growth. As you move from the left-hand side further right, generally the income component will come down a little bit and the growth potential can increase. As you continue to move across the spectrum, dividend and sector ETFs can offer a real good, a mix of both income and growth potential. And then on the far right-hand side, broad equity ETFs and thematics, those are focused on long-term growth potential, come with higher volatility and potentially increased risk in portfolios as well, but much less focused on income. So I just want you to take a mental note of this slide as I move through the next few illustrations. A lot of investors understand dividend investing and dividend ETFs. And what we see here, so I thought I'd start here and highlighted a number of popular dividend paying ETFs, BMO ZDV, Canadian Dividend ETF, US Dividend ZDY, Purpose, their US Dividend Fund, and ZDI, and International. What we're illustrating here is, basically we've taken a 60-40 portfolio and made it 50% of the total portfolio weight and added a 50% weight through a dividend ETF. So what does this show us? By adding this 50% dividend tilt, I will point out first off that it does change the asset allocation from that 60-40 balanced portfolio that we started with to an 80%, 20% fixed income portfolio. So it does change the risk return characteristics of the portfolio. However, if you want to maintain that 60-40 mix that we started with, you could begin with a core portfolio that's much more conservative, meaning heavier weighted to fixed income, and then add this dividend tilt, which will bring you more in line with that 60-40 mix. But with this example here on the screen, what have we done by adding this 50% dividend tilt to the balanced portfolio? We've boosted yield from 2% to 2.75%. We've added potentially more growth through exposure to dividend paying companies and lower fixed income. And in fact, as I mentioned, we can actually choose where we want that dividend exposure to come from. So we can pick a particular region, whether that's Canada, US, or international, to tilt the portfolio. And lastly, we've also introduced a monthly income stream, whereby if we look on the screen, the dividend ETF pays monthly, and that balanced part of the portfolio will continue to pay quarterly distribution. Similar to the, on the next slide, similar to the dividend example, here we're taking a 50% tilt to enhanced income ETFs. So these are covered call ETFs where the income is boosted on top of the dividends that are being paid out by selling call options and collecting a premium for that. Now, with these covered call strategies, we've moved along that risk, that equity spectrum, and we're focused a little bit more on the income side and a little bit less on the growth side versus the dividend ETF example. In this case here, you can see we boosted yield from 2 to 4%. And similarly to the dividend example, we've now introduced a monthly income stream by adding this 50% tilt to the portfolio. On the next slide, we can take a look at one last income-focused tilt, to the portfolio, and then I'll move on to two examples on the growth side. Now, if you recall that equity risk spectrum that I shared a few minutes ago, this is on the far left-hand side of that spectrum. So focused on premium income, low growth expectations, and in some cases, these come with reduced volatility, as we can see in the ETFs ZPay, which is BMO's premium yield ETF, and Purpose's premium yield fund as well, PYF. So we're giving up something to gain something. By including a premium yield ETF, we've added one, more potential income. Secondly, again, this monthly income stream. And third, a lower correlated complement to the broad market. So in many cases, these balanced ETF portfolios at the core will hold broad exposure to the broad markets, and adding a premium yield ETF can help to reduce some of that correlation. On the next two slides, I'm going to close off with two quick examples on the growth side of the spectrum. Many will be familiar with the broad market, the S&P 500, the NASDAQ 100, and we've seen these thematic indexes and these innovation ETFs continue to pave the way forward on the growth side of the spectrum. Here we can see growth of the S&P 500, NASDAQ 100, and an innovation index. And I will just mention that these are exposures that, again, can complement portfolios, but by using an ETF, it makes it simple and easy to access these segments of the market. And finally, on the last slide here, another growth tilt, or perhaps a growth and income tilt, but this requires a bit more skill and timing. I do point that out. It's another way to access, again, this growth or growth in income by rotating through certain sectors depending on the market environment. What we can see here is that this active approach, which some investors prefer, can allow fine-tuning to specific sectors, again, depending on the point in the market cycle that we're at. And again, I'll just close off summarizing what I just kind of shared. I mean, nothing's really specific to what we're doing on our side here at BMO. It's really to share again that the number of tools and the accessibility to ETFs to help with fine-tuning a core portfolio really continues to evolve. How that portfolio is tilted, again, really depends on the unique goals of the investor. Do I need more income, more growth, or perhaps a mix of both? The last slide's not here, but it's just awareness on our Market Insights webinars we host Fridays. I encourage you to take a look at etfmarketinsights.com. Come on out if you're interested to hear more from us on our Market Insights. And with that in time in mind, I will hand the stage over to Larry Berman.
Thank you, Mr. Burgess. And, my condolences on your Ottawa Senators. And anyways, I'm a huge Toronto Maple Leaf fan, and they've been so disappointing for so many years. But can't help to take a dig when we can get one here. So a lot of questions coming in tonight, which is great. I want to spend the first couple of minutes just talking about some of the risk factors that are popping up on my radar, an update on my thoughts on Omicron and what that might mean short term here, the recent hawkish turn in Fed policy that we heard out of Jay Powell this week, and then we'll dig into the questions. So now I'm not sure how many of you follow our Pro-Eyes series of indicators on our Berman's Call blog, but this is a snapshot of the summary page here from this week's presentation, and where you can see the valuation component of the market. 4 factors, the traditional measures, the top 3, where we look at enterprise value to EBITDA, which is, how much debt and equity does a company use relative to the earnings it creates? And we can see we're in the 95th percentile up there. So again, very expensive and top end of the range. When we look at price to sales ratio, so by revenue, how much revenue do the S&P 500 companies earn, and what are we paying for that? Most expensive of all time on a forward PE basis. Again, top 10% of where we are today. And the valuation metric that is still very supportive is what's called the equity risk premium, and that's what I want to look at here with you. And that is essentially discounting the earnings of the market by way of interest rates. And you've heard the idea there's no alternative, and bonds are very expensive, interest rates are so low, so that's why the stock multiple's higher. And when you look at it from that lens, stocks are more reasonably valued. But what that means is for stocks to stay with a higher multiple, we need the cost of money or interest rates to stay low. So the whole idea that Drew had some great ideas here tonight, that 60-40 balanced portfolio, and learn how to tilt it in the different directions towards income and growth, which were some great ideas there, Drew. So thanks very much for that. The problem I have is the bond side. It's the 40% to get you that balance that to me is an impaired asset class. And over the last couple of years here, we've talked about option strategies. A couple of weeks ago, we had the portfolio manager on from ZPay to explain, option strategies and how to generate these alternative sources of yield, because everybody needs that extra yield, that enhanced yield in their portfolio. And proud to say that BMO is the largest in Canada, in fact, the largest ETF provider in the world that does covered call strategy. So you are learning from the best here. Now, when it comes to business cycle, these are factors affecting the liquidity of the market. And for the most part, with the exception of the extreme support in terms of the fundamental side, so the New York Fed weekly leading indicator is really about shorter term data, and just because of the amount of money that's been colossally put into the economy from governments, and US in particular here in Canada, but this is a US indicator, that we've seen a surge in GDP growth, and that's kind of what's measured here. The best of that is in the rearview mirror. So this is a lagging indicator, but the fact that it's so strong historically would mean that the Fed would start to tighten interest rates, right? Because inflation pressures are building. So when we look at credit spreads, we see from a few months ago, credit spreads were incredibly tight. And in the last month or so, as the Fed has stopped their policies to support the junk bond market, they stopped buying corporate bonds. We're getting some value, meaning the spread's widening out between junk and investment grade credit. But what's gone on now is so unusual. It's very hard to compare the open free market prices that we see today trading compared to history, when the central bank wasn't an integral part of market manipulation. And I hate to say market manipulation, but make no mistake about it, quantitative easing has distorted the reality of the world. And so as the Fed this week says we've got to taper faster and unwind faster, why? Because inflation pressures are building. That's a great tool, by the way, from the government of Canada to see what your own personal CPI is. I'm going to go check that out myself on the weekend. Because my sense is it's running hotter than it is. Especially, I do a lot of the grocery shopping in the family, and I like to go to Walmart because. But you're even noticing at Walmart that prices are squirting up all over the place. The cost of money in funding markets is the slope of the yield curve, and right now that's very attractive. So the business cycle factors in terms of the risk we need to be worried about for a recession in a traditional way would be the Fed really clamping down and tightening up, and that is nowhere to be seen. So because interest rates are low, because the liquidity is still plentiful. Now, middle of next year, that might change after they stop buying bonds and interest rate pressures start to build. So that's on my radar, and I'm worried about that down the road. But for now, we're probably okay, and I've got some earnings we'll look at there. The tactical factors, the technical part of the market, the overboughts, the oversold, the breadth, the sentiment, the momentum, those factors have come down to really attractive levels. Well, I wouldn't say really attractive, but off the boil from the higher risk levels of a few weeks ago, when we were saying, hey, the overall Pro-I's index is now at the cautionary level. That's when the S&P 500 was over 4,700. We've come off a little bit, but I've got some slides to show you there. So the tactical part of the market says not a high risk factor at the moment, but under the hood, there are things to be concerned about. So having a look at the equity risk premium, or there is no alternative indicator because money's cheap. So the middle blue bar there, that's the earnings yield. And what you do there is you take the PE. So what is the earnings per share that the S&P generates? And right now, the forward-based earnings expectation for 2022, as we start get close to a new calendar year, about $235. $225 is about the number right now that the analysts think bottom up is going to be the number next year. Usually they underestimate a little bit, so maybe a bit higher than that because companies guide lower so they can beat on an easier basis. So it could be 230 next year. So that's pretty good. But the question is, what is the multiple supposed to be, or what should it be? Well, because interest rates are low and have been falling for decades, as Drew pointed out in one of his charts, you have the idea that the multiple should be higher and is sustainably higher because money's cheap. That other asset class Drew talked about doesn't offer you the returns, and there is no alternative. So the equity risk premium is the premium return you get by way of income and by way of capital gain over the safe kind of money and fixed income. Now, I use the 30-year bond. Some people use the 10-year bond, but equities don't mature. There's no maturity. So it's a long duration asset. The longer it takes for you to get your money back by way of dividends. So let's say you put $1 into a company, pays you 5% a year. Your duration's 20 years to get your money back by way of dividends. You still own the capital. So you've almost lent them money. They paid you dividends over 20 years. You got your money back, but now you have this asset and you've been paid your capital back. That's the concept of duration. So in a fixed income bond, you would say, well, at 30 years, I'm going to give the government money at 1.5%, or 175 in the long bond round, 177 in the U.S. long bond now. How many years is it going to take for me to get that money back? And you do some quick math, and you'd say, well, at 2%, it would be 50 years. At 1.77, it's 60 years, right? At 5%, it's 20 years, and so forth. So you adjust the valuation relative to bonds to stocks. And so right now, the earnings yield on the equity market is about 4.6. You can see that there in the graphic, compared to what you earn in the bond market, given that both of those are the longest term assets you can own in those classes. The equity risk premium then is the difference, or the yield you're earning in equities relative to the yield that you would earn in being in bonds. Okay, so hopefully I'm able to explain that concept of the equity risk premium. Now, what changes that equity risk premium are, unexpected events, are clearly rises in interest rates, a fall in earnings expectations, or a volatility event, something that could present a risk off, if you will. So all those things considered, from an historic perspective, equities are relatively okay valuation compared to interest rates. Okay. Now, earlier in this year, it was a much harder comparison, and the valuation on that class was a little bit higher. But again, it's a relative bet. When we look at the business cycle risk, what are the odds of a recession? So two things I look at: ECRI, Economic Cycle Research Institute, and you can Google them and you can check this out on their website. They have a recession probability indicator. The New York Fed has one on their website. I've talked about these for years. You can look at those and say, well, what are the odds of a recession? And right now, the odds are increasing, but liquidity is still very plentiful, and we don't really have to worry about too much that a recession's coming. But in 2019, we talked a lot about the yield curve inverting, and this red line and black line were rising, and the recession risk was growing. Now that recession risk 12 to 18 months out historically, but you can see this going back, that black line rises, into the actual recession. But there's a lead time, right? And it's typically a year and a half. So there's no indication now by the yield curve, cost of money, liquidity, that a recession is imminent. But again, what's different this time that we've never seen in history, modern history, going back decades, is the involvement in the government because of COVID to stimulate the economy because of the labor issues and just everything around the pandemic. So it really is different this time from that perspective. What isn't different is investor behavior. Investor behavior relative to their money invested, their savings, life savings, is always the same. It's emotional, right? You get the ups and downs. So that leads us to the next tactical indicator here, and that's the VIX and what's happening in the volatility markets. And so when you look at investor expectations of risk, you have this volatility curve, and what that is the VIX, the spot index. That is the expectation of volatility for the next month, right? So when they show the VIX on the screen, the ups and downs, there's a futures contract on every VIX going out for 2 years. For 12 months, basically, 1 year, monthly. So you've got the futures contracts that settle monthly. And so the expectation of volatility in the front month VIX, so the UX1 as an index ticker, whatever service you look at to follow that, I don't know what the ticker is, that's the Bloomberg ticker. The UX4 is the fourth futures month, so it always rolls as the futures roll. So it's the expectation of volatility over the current month compared to the expectation of volatility in the month 3 months from now. So it's now versus then. And if we're more worried about now, we get an inversion in the VIX curve, i.e. volatility premium now and to calm down later. So it's the relative expectation of, and then we measure this based on a standard deviation basis. So a month ago, when we were at a -2 reading at the bottom there, and a month before that, when we were at a -2 standard, that was complacency. That was the current level of VIX being so low, but the expectation of volatility rising for a month, 3 months from now, is really high. So that's a complacency factor. What we've seen since Omicron became an issue last week and accelerated by the surprise of the Fed change in policy to be more aggressively tapering, you heard from Powell this week, the VIX curve inverted, and now we're above 2 standard deviations. So when you go back and look historically, what you don't know is this VIX spike, the beginning of a spike like pre-COVID, where it initially went up to 2 standard deviations in February, cooled off, and then there was a, oh my God, the world shutting down, and we get an 8 standard deviation move. Or when we got a 12 standard deviation move, when the volatility futures blew up in early 2018, Or was it one of the pullbacks in 2017 where it was more like 2-3 standard deviations, which is much more normal behavior? We don't know. So nobody knows what this one's going to be. But historically, when the VIX expectations invert, you're getting close to a buying opportunity. And I think that's the case this time around, that it's an opportunity, not a panic situation. However, it may turn out that way, and I'll talk a little bit about that in a second. So what are we seeing behaviorally in markets, which is very interesting? So this chart, and one of the factors in the Pro-Eyes Tactical Series, is the percentage of stocks that are trending above their 200-day average. So here we have at the top the S&P 500 index, and we have the trend of the last month, the red line there, and we have the trend in the percentage of stocks above their 50-day average. Well, the 50-day average now, I should have that on the chart here, apologize for that, is around just under 4,300, right around those September lows. I contend that before this Omicron correction is over, we should test that support. Because what I'm seeing is almost now a majority of stocks have already broken their 200-day average. So market breadth is weakening. And once again, the big name players, the Microsofts, the Apples of the world, are increasingly leading the market and boosting the weight. So you're seeing the average stock start to perform very poorly. And that's usually a sign of weakness in the market. So market breadth is decaying, not improving, and that's a negative sign. So while the absolute level is not as intense as it was a few months ago in terms of the overbought nature of the market, where most stocks are well above their averages, we're now seeing this decay period. And so until we see evidence of capitulation, and we didn't see that today, we got a reversal, but very easily could be reversing as we speak right now. So, you know, as Asian markets are starting to open, we're starting to see futures weaken again. And, you know, that's just why volatility is elevated at the moment, and the VIX is up there. So, you know, that's something to consider. So here's the wild card. We don't know. We do not know what impact this is going to be. And anybody who tells you they know, but the market is very hypersensitive. So we got a headline today where someone in Minnesota was the second person in the US to be verified with this variant, but he was at a super spreader big event in New York with 50,000 people who were unmasked, and there was no vaccine requirement and so forth. So the odds are that he spread it to some of those, and they tell two friends and so on. And so how fast does Omicron spread relative to Delta? And that information that we have right now is higher. We don't know the potency of the virus yet. We'll know in a week. We'll start to get some information out of Africa and other places that saw this earlier. We're not going to get any information out of the US for a month in terms of the impact in the US hospital counts. We did hear out of New York State today that Delta, which is still the massive majority of cases, hospitalization capacity is now at 90% in ICUs and that kind of thing. So Delta is a big thing, and as we go inside, it's going to be another bad winter, we think. So I think we heard today that guys like me who weren't 70 and I couldn't get my booster shot last week, I can now get it starting tomorrow, I think. So go get your boosters, folks, and just protect yourselves. But we don't know what the market impact of this is going to be, and I expect volatility's going to stay elevated. So talking about the cost of money, and the Fed now says inflation is more than transitory, and it's really mind-boggling when you hear from these people and they have a narrative, and then what changed in the last 2 weeks from transitory a few weeks ago? Nothing. There's no bit of information other than
and again, I hate to say this, but it's painfully obvious. Powell now got the nod to be the chair again. And so now he can do what he may have wanted to do before he got the nod to be the chair. What a world we live in, right? So how are the markets going to respond to the less liquidity? So if they're able to pass another spending bill that would boost growth a little bit, infrastructure and everything, that is going to put pressure on funds because they need to issue more bonds. And up till now, the Fed's bought everything just about that the government issued. So that expansion of the Fed balance sheet that's pushing $6 trillion from pre-COVID to where it is now, the Fed just about bought every dollar that of new issue. Not everyone, but just about. And so when they stop being that buyer of last resort, what is going to happen to interest rates? Well, it's going to go up. Now, again, if you talk to my good friend David Rosenberg, he's going to tell you inflation's still transitory, and he's beating his fist on the table. And for the most part, I agree with him. A lot of the factors are transitory, absolutely. But some of them are sticking. And you're hearing more and more for companies. And there isn't anybody I know in business that hasn't boosted their prices. So there's a lag effect here, but it's going to start to trickle in. And at least for the next 6 months, the inflation numbers are likely to get worse before they get better. So this is why the Fed has to speed up here, okay? But they weren't going to make that announcement until Powell got the nod. So a bizarre world. But when we think about, cost of money and markets and multiples, so here's the forward earnings-based expectations year end. 225.51 for the S&P 500. Again, that's probably a little bit light, but in an economy next year that's going to grow 3%, maybe 2.5%, my estimate. Consensus a little higher than that. 15% earnings growth. Where is that coming from? Well, I'll tell you, the vast majority of that is share buybacks. Companies are making money and they're buying back shares, and that continues to be the factor boosting earnings per share. It's not organic business growth. So we just live in a highly manufactured world, and for the now, the markets just don't care, okay? The markets just don't care. So, with that in mind, let me dig into some of the questions here. I'm going to bring up my Bloomberg screen and hopefully make this big here so everybody can really see. You can see futures markets right now are off a little bit overnight. We're getting a little bit of a bid to gold. We're getting a little bit of a bid to oil. Those are basis off the futures markets close in the middle of the afternoon, not at 4 o'clock. And so that's kind of what's happening now. Bond yields are a little bit lower because we've seen a bit of a hit to equity. So let me dig into the questions here. There's a lot of them. I'm going to try to get through as many as possible. So first question here, and thanks to those of you who congratulated me for being a new grandpa, and it's just it's an incredible thing to see that circle of life come through. It's just it's surreal. So thank you for that. So with the season being known for tax loss selling and the Santa rally, would it be, in my opinion, that tax loss selling, sorry, hold on, make the font a bit bigger here. The tax loss selling should see an end soon, and the Santa rally would normally take place. So the Santa rally is really Christmas, New Year's. That's the technical definition. It's not all of December necessarily. There is a statistical weak spot, and it's the next week or so. Again, tax loss selling is a big catalyst for. So here's one of the considerations in tax loss selling season, and I got off a call this afternoon with the ETF providers, Crane Shares. Those are the guys that put the ETF together for KWeb, the Chinese. They largely concentrate in the Chinese market. and KBA and two of the ETFs that I own, and I wanted an update from them based on what was happening with Chinese ADRs and that whole thing. So I got a really good update from them, which is great. So one of the reasons that these Chinese internet stocks are getting pounded right now is because there's an expectation that in the new budgets, the Democrats are going to boost capital gains taxes for the wealthy. Not necessarily for everybody, but for the wealthy, 10 million plus, whatever that number is. And so you're seeing Elon Musk and others, insiders, start to liquidate some of their stock. But what they do on the other side of it is try to offset those gains with losses. So a lot of people with money that have investments are selling some Apple and Tesla and some of the big winners this year. And they're saying, well, what in my portfolio is losing money? And can I offset that so I don't pay tax, right? That's what you do. So tax loss selling is to say, well, I've got all these gains, and what can I sell to take a loss to offset? And so what we're going to see in some of the Chinese internet stocks, selling of the individual names, selling of the ETF, buying something equivalent so you keep the market exposure. So K-Tech or Z-Tech, there's an ETF, and I got to do some work on this, and maybe I'll talk about this on Monday's show on tax loss selling, because tis the season. So great question and really timely. But I expect this to happen. So we can expect some more pressure there. When is the daily bottom for this? Great question. If I knew the answer, I'd have all the money in the world. There's no answer. We don't know. And so they're really good questions, but there's no roadmap. There's no perfect, this is the day. There's seasonal patterns. There's about, around, close to, but so we're close to, we're about there, we're around that level. But I do think in the context of the Omicron uncertainty that in the next 2 weeks-ish, before Christmas, before options expiry in December, on December 17th, we're likely to see more important support level tested than we've already seen before we get some euphoria again for a year-end rally. We don't always just get a rally. There's a reason for it. But if the reason this year is tax loss selling, a lot of that's going to be done too in the next few weeks, that harvesting. People aren't going to do that in the back half of December because they're on vacation. So there's some seasonal aspects to that as well. And so hopefully that gives you some of my thoughts there on that question. So thanks for that. I've owned ZWB for a number of years. So it doesn't participate as much in upward markets. So let's bring ZWB in here. Let's have a look. And what I'm going to do here is I'm going to do a function on the Bloomberg terminal called compare. And what it's doing is it's comparing the total return. When Bloomberg and when BNN Bloomberg puts up a chart, what they're showing you is the price return, not the total return. And I've pointed that out to them for years, and they don't have a resource to show an index like this that shows total return, where you see your total return there, you see your price change return, and then an annualized number. Because we're looking at a 1-year chart, this is annualized. So the question is, why doesn't a covered call ETF keep up? Well, you get the extra yield, and you can see clearly that the price return, but the yield component is bigger. So the yield component on ZEB is the difference year to date between 30.53 and 35.16, right? So the bank's underlying bank distribution, call it 4.5% rounded, but you're getting 7.2 off ZWB because of the covered call premium. So if you followed the webinar from a few weeks ago with ZPay, Chris on the team that manages the option strategies for BMO
explained that typically when they do a covered call, they write 1 or 2 months out to earn that premium. They write at a level that they're happy selling it at. But in that 1 or 2 months, if the stock goes up more than that premium, they get called away here and they got to rebuy the stock at a higher level and rewrite the call at a higher level. Therefore, in a strong upward trending market, which has generally been the case this year, ZWB is most likely going to underperform just holding the underlying, because the additional yield isn't compensated when you're persistently having to buy those stocks back at a higher level. Now, if the markets are going sideways and most of the options are expiring out of the money, you earn the premium but never get called away, that's when ZWB does better. If you're in a down market and you're writing and it's getting called away, you're earning the premium, you're going to do better than just owning the underlying. So if you think you're sideways to lower, ZWB is better. If you think it's a strong trend up, ZEB is better. Very simple. And it applies to all strategies around, do I do covered calls to be a bit more yield and a bit more conservative? Or do I want all the growth and the income from the dividend? Right? And if you want all the growth and the income from the dividend, you buy ZEB. Again, touching on some of what Drew had talked about at the beginning tonight. So hopefully that answers your question. Next question. Some discount brokers offer commission-free ETF trading. National Bank offers commission-free trading on stocks and ETFs. Yes, they've been sponsors of ours. They promote it. A lot of our watchers opened accounts with them. But in Canada, it's illegal to pay for trades. So, you know, the Robinhood guys, the paying for trades, everything's free, Schwab. And so in the US model is different than the Canadian model. It is illegal to pay for trades in Canada. What has happened within National Bank is that on the business side of National Bank, on the ETF, they're market makers for ETFs. And they had a business mandate to be the #1 ETF market maker in Canada. So they want to see all the flows. They want all the trades to come through National Bank related to ETFs. So they were willing to offset the cost of trading, free trading, to gain market share. But that was a business decision that National Bank made. Now, theoretically, all the other discount brokers could do that if they had a business reason that they wanted to for some reason. Okay? So nuts and bolts, that's kind of the primary reason, I believe, that National Bank has done that and none of the others. They're not paying for order flow. They're trying to increase market share, add new accounts. One of the ways that discount brokers make money is on securities lending. And so you hold assets in your account, segregated, they can lend those out, they can make an interest on that, and primary way discount brokers make money are on your cash balances, on lending securities. The trading aspect of that, if they can break even, is probably a good business for them. So cost of trading has come down considerably over the years, and the discount brokers make money in lots of different ways. Cash balances and having that as a cash to them, where they can invest that cash at a higher rate and get a lower yield, basically pay you nothing on it, is part of the business model. So I don't know how many people knew that, but that's kind of a little bit of the mechanics that go on in the back end there. Alan's asking, what are the tax implications for a portfolio weighted in dividend income? So CRA, nothing to do with me, nothing to do with any accountant. The tax rules are very simple. When the tax is paid by a Canadian corporation, into a Canadian ETF, that distribution from the ETF or from the underlying company gets a preferential tax treatment as to avoid double taxation, meaning the corporations pay tax on their income, the dividend is paid after tax, and then they're taxing it again. So they give you a preferential tax treatment on dividends from a Canadian corporation because they're getting paid over here on that income. But when that dividend comes from a foreign corporation, government of Canada doesn't get that. The foreign government gets that. So the foreign dividend, therefore, is treated as income. So if you have a cash taxable account, that's where you should have, and you like dividends and income, you should primarily get those dividends and income from Canadian sources. In your registered account, where the tax treatment doesn't matter, except for that foreign withholding, that's always going to be there. Nothing you can do about that. But that tax treatment is on account of income. But because you don't get taxed in your retirement account until you take it out as income, it does not matter. So Alan, hopefully that gives you some insight into that. The tax treatment from covered call strategies, premium yield enhancement strategies, put writing, those are on account of capital, which means they're capital gains. So the distribution and the tax slip you get from owning a covered call ETF and a tax account, you see a return of capital in the box. That's not you getting your own money back, having to adjust your cost base. That is a capital gain. So you get a preferential tax treatment on that. Here's the sweet spot. If that is from a US ETF, so that dividend coming into that high dividend ETF is treated as income. But the premium from the option is on account of capital. So that piece gets capital gains treatment, even though it's from a foreign source. Something to think about. I hold a few BMO covered call ETFs. How do I find out what percentage of calls get called away, and where do I find the TER, so total expense ratio amounts? Tyler. So again, the PMO, the portfolio manager, one of them from the team that runs those for BMO, was on a few weeks ago, Zed Pay. Go watch the video. For BMO style, and they all do these things different. BMO style is to be long and write a covered call on half the equity position. Some of, like Horizon, tend to write it full positions. Some, like CI, tend to write it closer to the money, higher premium, but a small. They all have a different style. BMO style, half. So if it keeps going up, half. So only half the position calls away, not the whole thing. And their research showed that that was about the optimum amount, because sometimes the markets trend and sometimes they go sideways. And by doing half, you get the benefit of both growth and income. Great question. Larry, is it time to take a long position in XME? So for those that don't know what XME is, let's just go have a look there. So this is a S&P 500 Spider metals and mining ETF. If we look at some of the allocations, mostly US, a little bit of Canada, mostly mining, some steel, some coal. And if we look at the holdings, you can see some of the big holdings in there. So is it time to buy steel and base metals? And I would say yes. So let's have a look at the chart here. Sorry, wrong one. Throw my XME. I was evaluating J&J. for a potential purchase today. That was the last stock I was looking at. So here's XME, and here's the chart. And on the bottom, we're looking at the relative performance of, so that was a 5-year chart. So look big picture. I like to step back and I like to look big picture first. So from this perspective, theoretically, if this is a real breakout and a consolidation that's going to continue, because that's the pattern we're looking at now. The other way this pattern can resolve is this is a top and we come back down like we saw here, where we broke out, consolidated, but it didn't continue, it broke down. Okay, so what's going to come in the base metals and mining area? This outcome or a base and another break higher? So right now, it's kind of showing me we're still good here, okay? But to the extent that the central banks of the world are tightening up and the governments are not going to be able to spend and boost growth, then the steel and the base metals from an expansionary building standpoint, pulls back. I've suggested ZMT, which would be the BMO equivalent of this, is a good infrastructure play because you get the base metal and you get the steel exposure, and that's a good way to play infrastructure, as opposed to buying an infrastructure ETF where you're owning pipelines and utilities, and that's not what you want to do to play infrastructure. You want to get the PAVE ETF, right? So the PAVE ETF, let's have a look at that one. So this is the one that I've suggested here, to another one a few weeks back, maybe a few months ago now, to play the reopening, the infrastructure PAVE. Think of the ticker PAVE, building roads. And so when you look at what's in it, you look at the last few years, you can kind of see. So we can blow this up and kind of look at the last 1 year here and say, you had some selling. Why? Market sold off. So this in economically sensitive names are going to sell off. So is this a reversal? Is this time to buy this name? What are you actually buying? So again, if we look into the ETF and we look at the allocations and holdings, you have transportation, you have building materials. So this is different. This is not base metals mining. These are the companies that are going to build the roads and the bridges and the buildings. And again, if you look at what's in there, you got a steel name in there, and you've got the engineering companies, and you've got the automation and the technology, and you've got the guys that build the machines that these guys buy to build the roads, and so you've got the John Deeres, and then you've got some rails in there, and so this is an infrastructure play. And it's a real good one in there. So the transport piece is the rail piece of the infrastructure, and so I really like it. I like it as a great way to play it. Have we bottomed out yet? So I would say no, because I do think the broader markets and the S&P is going to test the 200-day and the September low, and I would wait for that. But what if Larry's wrong and we don't see that? Should you have exposure here now? And the answer is yes. So this is a tactical part of the overweight, underweight. And for my broad exposure, I've got about 2 or 3% between PAVE and base metals. If you broaden it out, I've got close to the 8 or 10%. That to me is not quite full. I've lightened that up recently. A full position there, big bet, would be closer to 10. But I'm still got a meaningful position because I believe reopening and we're going to get those infrastructure bills and so forth. So I like it still. Half a position-ish, make sure you're there just in case it doesn't pull back and we get another leg up. Risk return, pretty decent here. Great question. I have lost sound. That's probably on your end, not on our end. Where should ZLB be classified? Okay, so what is ZLB? So this is a low beta ETF. So as an investment factor, low beta. So what is low beta?
So if we look at COMP, right? So we're going to compare low beta to, and this is Canada low beta, to the broad TSX. So I'm going to take the BMO ZCN, the broad TSX, and I'm going to take the iShare XIU, which is the TSX 60. And we're going to look at those and we're going to say, well, what does low vol do in the last? Well, it's underperformed the index because these are lower volatility, less economically sensitive. So in a strong market is going to give you a better experience. Let's look at a 2-year experience. And so what did low beta do when the markets were coming unglued? It went down, but it went down a little bit less than the broad markets. It's still going to go down, but it's lower volatility. But as markets recovered, you can see how much it lagged. So it's a defensive holding. If you want exposure to Canada, great ETF to do that with less risk. But if we go into a bad market, it's going to come down. It's going to come down low beta. It's going to come down less. Probably, not guaranteed, probably. And if we have a look at what's in it, so let's have a look at ZLB. How do we classify it? And we look at, we've got utilities, we've got food, so you've got more consumer staples. You've got the food stores, the groceries. You've got some REITs in there. So if you look at the broad exposure of the TSX, and you look at the big weights there, what are those weights? So ZCN, and we look at what's in there. Banks are bigger, mining is bigger, internet, right? So you've got Shopify there, pipelines. So that's what you get in a broad index. But when you go into a lower risk index, you don't get that exposure. So it's going to lag in a market that's really strong because it doesn't have that. It's got 8.6% bank, not 21, right? You look at the holdings, individual names, Hydro One, defensive name, you're not going to get growth there. So you're asking how it should be classified. Hopefully that gives you an answer. Where can I find a recording of my webinars? So we post them all on our YouTube channel. So Larry Berman Official on YouTube, and we will put out links, and those are the replays. Ask Larry to move the mic to us. Yeah, I saw that. Yeah, sorry about that. Okay, sorry, I can barely hear Larry. Oh, that's too bad. I didn't see those until a little while ago. Okay. Okay, how are the brokerage offerings commission-free trading replacing that income? I understand payments for order flow is not legal in Canada. So that's a similar, so how are the brokerage offerings commission replacing? Well, they're not replacing, they're losing money on trading. They're losing, but they've made that business decision to lose money on trading. Trading isn't free. When you make a trade with an exchange, you must pay the Toronto Stock Exchange a fee, or the NEO, or whatever exchange it's trading on. There's about 20 exchanges now in Toronto, but Toronto Stock Exchange being the biggest. You probably heard a few weeks ago that the Chicago Board Options Exchange came in and bought, was it NEO, or they bought one of the junior exchanges here in Canada. So the competition, but exchanges make money for listing the company. They got listing fees, and they make money per transaction, every trade, a couple fractions of a penny, but every time. So when a trade is made, someone gets paid, and typically they have what's called a maker-taker model. So if you post liquidity, so let's say you put in an order and has a limit to it, and you don't buy, but your bid gets hit. The dealer gets paid by the exchange. Okay, so you put in a limit order, and the bid gets hit. You get filled. Great. You buy it lower. Great. The dealer that you're trading with gets paid for that order by the exchange. Who pays? The seller pays more to sell. So if you enter a market order to buy, that costs more. The liquidity provider gets paid, and that's and the spread between the bid and the ask on the trading cost is the profit of the Toronto Stock Exchange. Okay? So that's how they can make money and offset and minimize the cost and that kind of thing. So equal weight S&P or market cap weight? Great question. Let's have a look. So RSP is the S&P 500 equal weight, and let's look at it on the comp chart again. And let's look at that versus SPY Spider, market cap weighted Spider. Okay, and if we look at on a year-to-date basis, virtually identical. But as I said for months going back into last year, I think the average stock is going to beat, so the average equal weight S&P is going to beat the market cap weight S&P this year. And that was my call. But in the middle of the year, the spread here, if you kind of look at it, 16 to 23, it outperformed by 7%. So I had been trimming my overweight position in the equal weight S&P. I reduced it significantly, actually. I cut it in half. I still believe that the average stock beats the market cap weighted stock because when the Fed pulls this liquidity back, the stocks that are impacted the most are the highest multiple ones, which are technology and big cap tech. And that hasn't really played out yet in the Apples and the Microsofts and the Nvidias, and they're still working and they're still firing. But when they start to impact, like they were earlier in the year, that the market cap weighting of those big tech stocks will start to underperform the average stock. But here's so 500 stocks, equal weight, each stock is 0.2 in the index, right? Well, when we look at the S&P 500, and we look at the holdings and the weightings of the big names, Apple 6.75, Microsoft 6.49, Amazon, and so forth. When you get down to the 100th name, so there's 100 of the 500 stocks that are bigger than a 0.2. And a lot of them are marginally bigger than a 0.2. When does it start to make a difference? Probably around a 0.3 when the stock is 50% more weight in the index than the equal weight index. So that's the top 70 names, right? And so forth. So when you start to look at those names and what they are, they're all the Dow stocks. They're a lot of the QQQs and so forth, right? That's just, what's the top part of the index. So when you're buying the index and you say, well, what are the top 15 names worth? And you start to say, okay, 13, 20, 30. The top 15 holdings are 40% of the index. So look at the names. What is the risk? What are the names? If the average, so if JP Morgan's in the equal weight index, it's 1.2. You're going to underperform if that name's leading, and the same for Berkshire and so forth. So, and Facebook. So if you look at the big cap tech, that's where I think the problem is, and the equal weight beating the big cap tech. So I still like it. I haven't added that position back yet, but in the tax loss selling season here, I'm just looking at behaviors. I want to start to see the selling in those big cap names a little bit, And then I'm going to flip that back to a bigger weight and equal weight S&P. Great question. Could I analyze light speed here? Okay, so I'm not the meme stock guy. And when you look at a name, and you want perspective, you want years of behavior. So so you look at this and you say, it's been out a year. So what can the chart tell you? And when you don't have long-term perspective, the charts are useless from a structural long-term, like, okay, the economy was hot 5 years ago. What did this stock do? Interest rates were really ramping up here. What did the stock do? So you lose that aspect of analysis, but you still have the fundamentals. So you say, well, what do the analysts think this stock is worth that do the fundamental work that cover it? So on Bloomberg, these are the names. 19 guys cover it. There's been more upgrades and downgrades. It's got a green arrow recently, so it's an upgrade cycle. What we can see here, 4 out of 5 is pretty good ranking, but there's some holds in the sell. So I like to say, well, okay, this guy just came out this week or last week. What did he say? Why did he reduce it? And I'd kind of go look at if I can get some research on what this guy said, and I kind of do that. Now, I've got access to some of that stuff that the average person doesn't have, so fair enough. But I like to know why he downgraded it and so forth. So they downgraded it to $62. It's trading at 48. The guys that like it'll outperform basket, the recent neutral. So even the guys that are neutral on the stock still have a much higher price target. Okay, so let's dig into some of the fundamentals. So let's kind of look at the financials here. And again, you don't have history here because it's just became a public company. You have what they earned kind of when they were private, and so you don't have details, and that's just, okay, whatever. So what do they earn? Well, it turns out next year they're expected to lose money. So these companies that are thematic and storied, and you got a lot of, oh, I love it, and I love this, and here's the story, and insiders, what are they doing, and all. So you look at what's going on and what sector are they in, and you realize that this is a company that doesn't have stable earnings. They actually don't make money. If the shit hits the fan and things go bad, these are the companies that get hurt. So going back to the chart, trading versus investing. So would I invest in, there's an oversold RSI. It was oversold here. You got a reversal indication there. Got a bit of a confirmation. It fails. So you look at a year to date. Someone had asked about tax loss selling, and you look at the name and you say, well, where was it beginning of the year? Where is it now? So right recently, this is now a tax loss candidate. So over the next week or two, it could bounce here, but really this is probably a name that some people have owned, and now it's in tax loss range against some other names where there's gains. And so we might see another week or two. I don't know, because I don't know, of selling. Is this a confirmation of a bottom or not? No, it's not. Is it oversold? Yes, it is. Do you trade it? What's your hold period? Is it days? Is it weeks? Is it years? Do you love this thing forever? Are you just a Cathie Wood fan? So, Kat, great question. That's kind of how I would approach it. Know the story, knows what moves the stock, know they don't make any money. They may a few years from now. They're vulnerable to rising interest rates because they're the longest duration asset. Remember what I said about duration if you were listening early? By way of dividend, by way of earnings of the company, how long does it take for them to pay you back? Well, if they don't make any money, you're not getting any cash from them. So they're the longest duration asset possible. And if interest rates are going up, which I suspect they will into next year, inflation and a tighter Fed and more supply coming from government spending deficits, you're going to have pressure on these stocks. So it applies across the board for all of them, not just Lightspeed, all of them. So that's kind of how I look at it. Tradable, couple days, couple weeks, sure. Is it investable yet? I couldn't tell you because there's not enough information for me to know that. As someone who's a fiduciary that you would trust and say, yep, I'm buying this for myself, right? I'm going to put this in my kid's university account. No, well, my grandson's university account. No. Okay. Can you trade it? Absolutely. What's your horizon on that? A couple weeks at best. You're oversold. You get a pop. Maybe it rallies back to 60. There's some resistance there. You can do the retracements. There's certainly a gap. You're broken below the 200. Listen, it's tradable. It's a theme. It's a meme. It's there. So great question. It's puzzling that central banks are loading up on gold, but at $1,800 ceiling, maintain, especially with the messaging and these really big disconnect. Any insights on gold? It's been the most frustrating trade ever. Gold stocks remain one of the cheapest asset classes on the planet. What is going to release the value in gold? Well, it's clear, and this has been a narrative for a long time, the younger crowd has migrated to crypto. Some of the major crowd has migrated to crypto as the way to play that uncertainty, inflation hedge away from gold. So that central banks are buying, but you lost a lot of the investor base that otherwise would have been buying. And because gold historically has always been cyclical, and you have a boom bust kind of thing in gold, people are speculating that as interest rates go up. So it's the real rate that matters. And from that perspective, it's been a dramatic disappointment. I think it should be way higher than it is, and it's not. So I've been trimming. Do I want to trim? No. Am I adding to my position yet? No. Will I at some point? Yes, where I have room to do that, but I had trimmed into strength so I can add into weakness. So those are some of my, is it puzzling, Jeff? Yes, it's absolutely puzzling. Last year, inflation was suppressed due to COVID, so aren't we comparing this year's inflation to a lower artificial number? So yes, so you have those year-over-year effects, absolutely. But the dip last year was energy, and broad prices didn't fall. Walmart didn't cut their stuff 30%, right? Like that. Your core goods didn't have that volatility. Energy prices did, for sure. And so what you pay at the pump. So that aspect, yes. Did your rent go down? No. Your rent went to zero because you couldn't pay, but there was substitution. So it's a good question. But the factors driving CPI in terms of owner's equivalent rent, in terms of your basket of goods, what component of it is your energy consumption? And that's small for the average person. Depends how much you drive your car to work, I guess, but that's small for the average person. So I think your lens here, Ishwar, is too focused on that and not the bigger picture of rising wages, supply chain issues, which are supply side. I read a great book years and years ago, highly recommended if you can find it. You can probably get a PDF of it somewhere on the internet, called The 7 Types of Inflation, and it was written decades ago. But there's supply side inflation and there's demand side. Core inflation is people's willingness to spend more and the ability to spend more. So you can spend more in two ways. Your income's going up and you have the capability, and you've got, or you borrow and you're willing to make your balance sheet worse, credit, in order to fund consumption. That's usually a bad thing. making your balance sheet worse off to invest, and that asset you're investing in creates income, good. So there's different types of demand and supply issues that lead to aggregate demand and consumption that drive inflation pressures. What we're seeing now is very different than what we've seen for decades, where unions are starting to get a little bit of, but a little bit. The base salaries are going up. You got to pay bonuses. We never had that for decades. So it is a bit different there, and it bears a lot more close scrutiny, because core inflation is a change in attitude. It's a behavioral change to know that that TV that you see in the store is $800 for the 65-incher, but I know next month on Boxing Day it's going to be $700, and I'm going to wait. But if you thought that the price is going up, it's $800 today on sale before Christmas, and the Boxing Day sale might still be $800, but in January the new model's out, and now it's going to be $900. You buy it today. You don't care what the price is, because it's not going to be lower. So in your basket of goods and services, how much of that do you have where you believe the price is going to be better on sale here? Or do you want it and need it now because you think it's going to go up in the future? And it's that it's the change in expectation of inflation that will lead to core increases. Part of that is a company saying, listen, all my input costs are going up. Now is a good time to raise revenue. Nobody's going to balk at that. I'm not going to lose market share if I raise my price. Why? Because everyone else is raising. We're all experiencing the same things, right? Ishwar, so that is not artificial. That's real. And that is very different today. So you got these onshoring and taking technology that was made cheaper over there and now making it here in the name of national security, and jobs here, not there, and all that stuff's inflationary. So I think it's going to be far more sticky than my friend David Rosenberg and some others. But are we going to go back to the 70s where unions are getting wage demands of 6, 7, 8% a year? No, I don't think that's coming. I do think there's going to be shortages of labor. I do think there are big skill set mismatches to the person who got laid off during COVID at 55, and that job's been replaced by artificial intelligence, or they've merged something and they've cut some cost out and that job no longer exists, but they need a new coder here. And so that company still has a job, but that job is not middle management. That job is a Python coder that just graduated from school. And it pays more actually than that middle manager job, because they can increase productivity with that job versus having an extra layer of management. That we're seeing that shift. You don't see it, you don't read about it, but that's part of the mix. That skills mismatch is a labor booster. So I love the inflation debate, and I love the inflation question, and it's really good, and I'm glad I could provide some color around that. So we've only got a couple of minutes left here. Let me see, and there's a lot of questions here. You know what? Let me know, guys. Fill out the feedback survey that you're going to get tomorrow. Do you want more of this type of thing in these, where I could go for a full hour plus and really answer all your questions? You know, and so I'm happy to do those. It's certainly less work for me up front into preparing content and lining up speakers and all that. So I'm happy to do those. If you guys like this format better, I can do it every other time rather than having guests on. Or so let me know, because I'm here. I'm doing this for you. I love the educational aspect of it. But unfortunately, it's 8:29 now. We've got a minute left. So I'll take one more question here, and then we'll move on. let's see here. Canada Euro, hedged or unhedged. So when you're investing in a ZWE or a ZWP, that's high dividends Europe covered call strategy, hedged or unhedged. Your biggest exposure is Euro CAD. It's the cross currency rate, right? So it's helpful to have a look at a chart and say, well, let me get a big picture range view on currency, Canada, Europe. So, you know, what happened in 2012 to get us down there? Well, that was Europe going through the pigs crisis and the weaker economy and that ripple effect from the great financial crisis and downgrades to Europe and credit starting to have negative interest. So are we going to go back to that? No, we know all that. So we're probably not going back to those levels. What was this spike up here where the euro got really strong, and what were those? And so where are we now? So this, right, 2014, what was 2014 and 2015? Well, that was oil prices collapsing and the Canadian dollar, you know, having an impact on the Canadian dollar. Sorry, this was oil prices collapsing, right? So Canadian dollar getting weaker. Canadian dollar, this up is Canadian dollar weaker, right? Going, so 145 to 160, Canadian dollar weaker relative to the euro. Europe, Canadian dollar stronger relative to the euro. So as oil gets stronger, so what are oil prices going to do relative to Europe? That's a big factor there. So I would say this, and this is my plan here. I've been trimming a little bit up in here. I didn't add. I should have against these lows because technically the risk reward was good, but I didn't. So back above 150, I would look to trim Canada Euro or hedge it. And then back down around here, would look to add more. Anyways, we're out of time, folks. Thanks a lot for tuning in tonight. Again, reminder, if you can support one of our charities this time of year, holiday spirit of giving, please consider it. And I would be thrilled and honored to match your donations dollar for dollar. Have a great week, everyone. Next week, next Thursday, will be the last version for this series of the Roadshow. And we'll wish everyone happy holidays and happy for those celebrating Hanukkah like myself. You know, happy Hanukkah to everybody, and have a great week.